and you're welcome to Global Business Insights, where you get the details behind the leading business headlines and latest data shaping major economies. Just in, monthly GDP growth in the United Kingdom decreased to 0.10% in February, as expected, from 0.3% in January. Earlier, we saw Singapore's Q1 GDP growth up 2.7% year on year, faster than the 2.2% growth in Q3 last year. Growth, however, in the manufacturing sector slowed to 0.8% year on year, down from 1.4% in the previous quarter. The latest US factory inflation data, coming lower than expected yesterday, supported an attempt at rebound in US stock indexes from the previous session, as shares in big tech companies led the march higher. S&P 500 was up 0.7% after falling almost 1% in the wake of a hotter than expected US inflation reading. The Nasdaq also rose 1.7%, reversing a 0.8% decline on Wednesday. Gold hits another fresh high near $2,390 in early trade as rising geopolitical risks continue to boost safe haven assets. Oil prices also again inching up in early trade as OPEC releases its monthly report and on heightened tensions in the Middle East. On US inflation, all eyes are glued on the Federal Reserve's preferred deflator, the Personal Consumption Expenditure Index, which typically combines elements of both the wholesale and consumer indexes. And as usual, the guidance and outlook from the major US banks will be the focus, as Q1 earnings continue to be boosted by high interest margins and bullish stock markets. With markets now priced to perfection, the expectation is for nothing but stellar performance, with all eyes dotted. And even a solid start to 2024 will be routinely overlooked if forecasts fall short and any adverse blips show up in the details. In the afternoon, we will discuss lessons from the first set of earnings releases from the largest US banks. As we get those earnings, we should also see weaker loan growth, restructuring costs holding back performance, and additional loan loss provisions. And on data later today, we will get the University of Michigan Consumer Sentiment Index for April. Expectations are for a 78.7 reading, slightly less than the previous print. The ECB yesterday left rates unchanged as expected, leaving the door open for possible rate cut in June. We covered that yesterday. We will replay our take on yesterday's speech by IMF boss Kristalina Georgieva on the global economic outlook ahead of the IMF spring meeting. She also said policymakers must resist calls for premature cuts to interest rates, adding that the Federal Reserve should be able to start cutting interest rates by the end of 2024. On Monday, we also get Nigeria's CPI reading for March. Monthly gross domestic product in the UK decreased to 0.1% in February. That was lower than the previous month. Retail sales growth slowed during a wet February when storms kept people at home. Services output, however, grew by 0.1% in February 2024, following growth of 0.3% in January, while production output grew by 1.1% in February and was the largest contributor to the growth in GDP in the month, after a fall of 0.3% in January 2024. Construction output, however, fell by 1.9% in February 2024, following growth of 1.1% in January 2024. At best, somewhat mixed and fragile recovery, but the economy does look like it's coming out, albeit marginally, out of recession. We also got industrial production and manufacturing production also rising, beating both expectations and the previous month's reads. Large tech companies were the big winners again yesterday as Amazon, Alphabet, and Microsoft went up 1.7%, 2%, and 1.1% respectively. Amazon closed at a record high since 2021. Remarkably, Apple and Nvidia were up more than 4%. Earlier in the week, we saw Nvidia flirting with correction, and Apple had been seen as the laggard, you recall, in the stampede to get into the artificial intelligence rush. It was, however, reported that Apple now aims to boost its sluggish computer sales as it overhauls its entire Mac line with a new family of in-house processors designed to leverage the very latest artificial intelligence capabilities. The new M4 processor chip comes in at least three main varieties, and Apple is looking to update every Mac model and possibly other devices with it. It couldn't come at a better time given that Mac sales sank 27% in the last fiscal year, and we do know that Apple tends to wait a bit to be sure that it comes with a strong offering given its differentiation strategy. This time it also needs to be regulator proof, especially at a time of more intense scrutiny in an AI space already tagged dangerous by observers. Apple shares soared 4.3% yesterday on the news, also its biggest single-day gain in almost a year. With Nvidia also coming back with gains, the AI mania is nowhere near petering out as markets look to the earnings season for fresh catalysts to sustain optimism dented by the worrisome inflation data. Ahead of the Managing Director, IMF, Georgieva Kristalina's speech today, the International Monetary Fund World Economic Outlook report said global growth could drop by about a percentage point below the pre-pandemic average by the end of the decade, implying reversal in improvements to living standards and limits to the prospects for global income convergence.
The simple truth is that perseverance in good policies is the only avenue for success. In a world of more frequent shocks and heightened uncertainty, we need good policies more than ever. Making the right policy choices will define the future of the world economy. It will define how this decade is remembered. Will it go down in history as the turbulent 20s, a time of disruptions and divergence in economic fortunes, or the tepid 20s, a time of slow growth and popular discontent, or the transformational 20s, a time of rapid technological advancements for the good of humanity. You will see in our World Economic Outlook next week that global growth is marginally stronger on account of robust activity in the United States and in a number of emerging market economies. And inflation is going down. The resilience of the world economy, mostly due to the sound macroeconomic fundamentals, the good policies that Acheson talks about, that we built over the last years. This resilience is helped by strong labor markets and an expanding labor force. Overall, based on the data, it is tempting to breathe a sign of relief. We have avoided a global recession and a period of stagflation, but there are still plenty of things to worry about. The global environment has become more challenging. Geopolitical tensions increase the risk of fragmentation of the world economy. And as we have learned in the past few years, we operate in a world in which we must expect the unexpected. The sobering reality is global economic activity is weak by historical standards. Prospects for growth have been slowing since the global financial crisis. Just look at this graph. And inflation is not fully defeated. Fiscal buffers, on the other hand, have been depleted, and debt is up, posing a major challenge to public finances in many countries. The scars of the pandemics are still with us. The global output loss since 2020 is around $3.3 trillion, with the costs disproportionately falling on the most vulnerable countries. And we see a growing divergence within and across country groups. Among advanced economies, the US has experienced the strongest rebound, helped by rising productivity growth. By contrast, activity in the euro area is recovering much more gradually, reflecting the lingering effects of high energy prices and weaker productivity growth. And what is most striking is divergence for low-income countries, for whom the scarring has been the most severe. Among these nations, fragile and conflict-affected economies are bearing the heaviest burden. The primary driver of weaker growth is a significant and broad-based slowdown in productivity. Our analysis shows it accounts for over half of the growth slowdown in advanced and emerging economies, and nearly all in low-income countries.
Policy leaders should not be deceived to think we are in worse times that will get better, when in truth we may be in better times about to go worse. She called for countries to deal with inflation, rebuild depleted buffers, and address low productivity with a transformational approach, forging corporations, international corporations that support the desired transformation. There are many questions that developing countries like Nigeria need to have clear answers for. How can we build buffers for a tougher future environment given present pressures? What can we do to energize people to enhance productivity and transform economies? How can governance in government be disciplined and motivate positive reforms in all sectors, and I say all sectors, to deliver quantum leap improvements? The focus is on quantum leap improvements in quality of life that is sustainable in a tougher future. How can decades of sustained fiscal leakages be decisively plugged so we stop racing with an engine with permanent oil leaks, which has led in the past to a start, stop, go back and start all over again mode of economic growth? And finally, how can we leverage new technologies to transform to create a much better and resilient future growth scenario? All this starts with strategic and bolder rethinking and execution to produce a better life for citizens tomorrow, while of course not underestimating the scale of fires that have to be put out and the tactical adjustments also needed. And of course, accelerating investments and action in deploying the vital transformation productivity catalysts. Finding capital, I don't think, is the big challenge, especially where many economies sit on massive chests of state-owned, under-leveraged, and often less productive assets. We must indeed think more of fortifying for the leaner years and expecting the unexpected, as Kristalina puts it. And in closing, we look at Asian stocks. Nikkei 225 up 0.21%, the Hong Kong Hang Seng down 1.87%, while the Shanghai Composite is down 0.49%. The Chinese Shenzhen is also down 0.78%. The South Korean Kospi also down 0.93%. Well, that's it from me on Global Business Insights. This is Bode Oshosanye. Please share and kindly follow on Facebook and LinkedIn. Subscribe on YouTube and X. Thank you very much for watching and following. Bye-bye.